Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey, everyone. I hope you're having a great Saturday so far, resting up after that crazy week. One of the stocks that was sort of doing well, Bitcoin held in there, of course, which I'm a little surprised about. We see that basically Bitcoin tends to be at least in the last few years, has been sort of risk on, risk off. So if you sort of overlay Bitcoin with a chart of triple levered 𝐾𝐾, it looks very, very similar until lately, where the Nasdaq has fallen off a cliff and Bitcoin's kind of hanging in there. So that's a good sign. Could mean that it still has some downside if there's a true liquidation event, right? So I've seen a number of bull and bear markets and a lot of crashes, and what tends to happen is they sell the safety when there's truly a liquidity event, right? When people need to raise money anywhere they can to pay for margin calls, to pay for pain elsewhere, to roll into some things that have been really, really sold off. So you'll see things like gold really sell off, and then eventually it becomes a place of safety again. So that tends to be how things play out. Obviously, no guarantees of anything, but in my career, I've seen that a lot. So we'll see if Bitcoin is that source of liquidity if things do continue to get ugly. But having said that, really, really good resilience this past week. So we can see MSTR, which quite frankly has acted fairly well since kind of that March 10th sell-off in markets. It's come back a little bit, even though Bitcoin isn't at $100,000 again. It's kind of come back, performed very well, rallied about $100, has pulled back with the broader market, but on Friday acted kind of well, pulled down almost to this trend line here. So we're seeing a little bit of a above trend line sort of support here, and we'll see if it keeps going. So one of the things that's kind of interesting about Bitcoin is that the volatility, as I've mentioned in a number of places, hasn't been very high. So I started looking at this as it had come off a little bit and reached not quite those levels of mid-February, but kind of down around the 73 IV level, which is really quite cheap for an MSTR. Going back, it doesn't really get much lower than that. So I sort of looked at this, everything else kind of starting to blow up, and it pulled back to about 80, and I said, this is kind of cheap. So I put on what's called a strangle, right? So not a straddle, it's a straddle, but with the strikes moved far away. So I'm going to show you that right here. So I put on the June. I wanted to give myself a little bit of room, okay? And the June had been pushed down a little bit as well. So I wanted to give myself a little bit of room. I tend to do that when I pick a long option strategy. You kind of want to think of where that decay is. So you've got to kind of figure out where you want to be on that decay curve, right? When you're short options, you want to be closer to the sort of more rapid decay part of the curve, which tends to be a sweet spot of, say, about 20 to 60 days, 25 to 60 days. When you're long options, you want to give yourself some time. You want to be further out on that decay curve, so you're not really you don't have that big theta bill. And you have the ability as well for some Vega expansion. So when I put on a position like this, you'll notice here that this has, on a 5 lot, has 431 Vega. So if implied volatility goes up, I'm going to make $430 for each point that implied volatility rises in this particular month, right? So you have to understand that this is in this month. If volatility rises in March, it's not going to be the same thing, right? So as volatility rises, it tends to rise in the front part of the curve first. So in those nearer term expiries, then if it's durable, more persistent, the further out ones are going to rise as well, like a June. And that's exactly what happened here.
Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video.
So we can see that really the whole curve has shifted up. You see that? So these are the near term expiries, these are the further out ones, and the whole curve has shifted up into that very, very big sell-off in markets. So the interesting thing is I put this on, I thought that the volatility is a little bit on the cheap side, but what we see here is that implied volatility has risen, right? So even though I put this position on up here and it was delta long, so we'll look at that in a moment, I'm actually up money on it, even though it's gone against me a little bit, only a little bit. So let's take a look at the position long 431 Vega. And I put these on put the calls on at 23.95 and the way out of the money puts at 16.15. So what this does is it creates this profile that basically it's almost like saying, well, I'm not really sure which way this is going to go, but I'm going to lean a little bit long. I don't want to be too aggressive. A straddle would be more aggressive, right? I'm going to be paying a lot of time value, a big money to have something that's going to really immediately get me more of a push. And I'm not 100% certain, as we probably can't be 100% certain about anything, but I'm not certain it's really going to go. So what I want to do is position myself into something a little bit less expensive in some of that skew that I think is actually not that expensive. Let's take a look at the skew. It is not really that expensive. Look at the downside skew is pretty steep once you get way, way out of the money, but really down in here, we're not even at the 90th percentile, and that's current. So it's popped up a little bit as I'm going to show you. And look at the upside skew. We're really not pricing in some sort of explosive upside potential as we normally do. This is the sort of 90th percentile of what can be charged for a 3-month out call at that 500 level. Right, so look at how low the skew is for that upside. So I'm kind of paying inexpensive skew, and so we were talking about this in the community, and I've talked about this with a couple of mentoring students. This is kind of it. It's not so much that I think Bitcoin is going to go to $150,000. It's that I'm playing trades that give me a little bit better odds. And I have this idea that I'm going to lean into it a little bit more. It's been acting fairly well. On the one hand, Bitcoin could come down and follow risk off but it hasn't. And so I find that somewhat encouraging. So I've placed myself at the 350 call level, and I've put in this 210 put for my little Vega bailout. So I'm going to call this my Vega bailout strategy. And what it does is it places me right here where the market's trading, let's say about 295, I think it is. And we are long deltas, right? So we got 114 long deltas right here. I'm leaning to the long side. I favor that upside because the delta is going to start making me money right away. I have the Vega that's now paid me a little bit. So let's see. I paid $23.95 for this call. Where is it trading? $25.30. So I'm up $1.40 on this call, even though the stock's down about $15. Now let's take a look at the put. I'm actually up over $1 on this put. What is that? $1.15, and the stock's down about $10. They shouldn't be up $1, right? So what's happened here is we've seen the overall the term structure shift up as I just showed you, and that has lifted the value of this position, even though it hasn't really gone anywhere or it's gone down a little bit because of this Vega exposure, right? I'm going to make $1. I'm going to make $431 for every 1 point move up in implied volatility. And that's really kind of the idea behind this. So let's take a look at that MSTR at the money vol. This is your 30-day, right? So 30-day is kind of always interesting to look at. It gives you a good barometer for what things are doing in general. But let's look up the 90-day. Just to take a little closer look at this. By the way, I have a great code on bar chart. This is a phenomenal platform. I would not recommend anything I didn't think was excellent, like a 10 out of 10. The gamma profiles, I'm not super sure on the data. Everything else in this program is phenomenal. And you can see down in my description that you get a really nice deal on this. Anything like this would cost 5 times as much, this kind of data and this kind of volatility analysis. So here's this volatility jumping here. See this little jump? That's what happened Thursday and Friday. So we got in down here and we benefited from that Vega pump. Now, this is the at the money. So why don't we take that upside is probably about a 25 delta. It's going to look pretty similar. There you go. Pumping up again. So look how the skew is kind of low. So when you look at the fun part of looking at, you can look at skew charts, right? I can show you something like this, which is going to give you skew. And something like this, we can see that upside skew is actually very flat. This is more typical of MSTR because people play that upside, that explosive upside. But right now, you can see in particular, it's very small here, but we're trading above the 0 line, which means that puts are a little bit more expensive than calls. That's actually quite unusual for this product, right? It typically trades with calls a little bit more expensive, kind of like a gold. But interestingly enough, both gold and MSTR, and I think Bitcoin as well, but I'd have to take a look, are kind of inverted from what's normal. So kind of an interesting play there, right? That's why in the community, I put in a trade on downside gold because I thought liquidity would sell off gold, and it did on Friday. We'll see if it kind of hangs in there. But the downside skew is actually kind of expensive, which is unusual for gold. So I played that downside put ratio. So getting back to this, what this position does is it doesn't have a high theta bill. There's always Vega exposure, right? If the vol comes down, I'm going to get hurt. But there's not a high theta bill on this, typically, as high at least as if I'd had sort of more at the money. So I've kind of positioned myself out here. I've spent about $42 on 5 lots. So if you did a 1 lot on this, you'd spend about $4,200 on this position. And so if you kind of see how this thing works, if it starts to really go up, what do I have working for me? Well, I've got my delta. I'm long 100 deltas. And my target on this thing is kind of up here, sort of near 400. I mean, if Bitcoin really goes nuts, then all bets are off and we can keep going. But at this point, I think we have a relatively good chance. I looked at these 350s the other day in June, and they're cheap. They're cheap. And that's because of that upside skew I was telling you about. Very flat. It's very interesting that it's flattened out so much, especially in this market. And vol was just a little bit too low in general. So for now, we've made a little bit of money. We're going to see how that it can be fleeting, right? It can be fleeting in this market. If we see the VIX go from 42 back to 30, and this thing doesn't do anything, you can bet this volatility is going to come down. This option price is going to compress a little bit. But right now, we can see this sort of negative volatility risk premium, right? This thing is moving, even though it doesn't seem like it's done a whole lot, except maybe lately a little more. We've had a few big moves. You can see this realized volatility still reflecting quite a bit a higher level than the underlying pricing, right? So what we call that is sort of, we would say this is cheap. Now, you can't make generalizations. You can say this is kind of cheap vol, but it also depends. Like this realized volatility is absorbing 20 days of vol, right? So as these days come off of the calculation, we should see this come down, right? So it's not always, it's a bit of art and science. You're certainly looking for this volatility risk premium, which tends to be kind of, you can see it tends to be on the cheap side. There's a very, very good trader out there, crypto guy, who says that volatility tends to be more expensive on this product all the time. That's just not true. It isn't. By this evidence, you can see that historical volatility tends to be higher almost all the time. So that's completely untrue. So you want to make sure you know what you're talking about. But these charts are definitely not, it's not just kind of, take a picture and take them at sort of face value. You kind of have to understand. What I do like to see is that implied volatility is starting to rise. I believe we could say realized volatility hang in there. So I do believe these are cheap on an absolute basis and on a relative basis. And I think they will remain so for some time. I think Bitcoin's probably ready to kind of decide where it wants to go. So what this position is going to do is it's going to make money to the upside immediately. But if I'm wrong, I get my Vega bailout. And what that means is if it goes down, I'm going to be losing money on this delta, right? So I think that it's going up. But if I'm wrong, I've kind of, in my thesis, I've built in this idea that if it collapses, we're going to see probably a pretty big run up in implied volatility. Right now, we've already made about 10 points of vol. I could see this thing go up another, I don't know, it could probably go another 15 to 20 vol points. That's in the near term. So let's take a look at our specific vol here. Probably not that much. So I think we could probably easily get back to an implied volatility of about 109. And that's going to be about 14 vol points. So I think there's a reasonable upside of 14 vol points in Vega, of Vega exposure. And what that means is my Vega bailout is going to bail me out of my wrong delta. So I'm long delta. I favor the upside, but if I'm wrong, watch how it's going to start to correct, right? Because it's a strangle. So this put is going to start to pick up value and pick up delta, negative delta, which is going to take away from my positive delta. So I'm going to get hurt a little bit down here. As you can see, I'm going to start losing a little bit of money, but this is going to start picking up value as this call gets more distant and slows down in terms of the value that it's losing, the delta that it has. And this starts to pick up, right? So this is kind of your backup plan, this downside put, that look, if this thing falls apart, maybe it could get back to 150. So that's what I want. I want this ability to really get bailed out by the delta in this put that is really going to start to kick in down there. But my Vega bailout is that I think I have some Vega exposure. So let's take a look at my Vega exposure here. So one interesting thing about Vega is with a lot of time left, of course, we know Vega is very, very high, but it tends to spread out a little bit more, right? It doesn't have a sort of localized performance as much. So you can see these two strikes are kind of blending to give us kind of a mid-range high Vega. Now watch what happens when we move things forward. So I'm going to go from April to May. Keep in mind, these are Junes. We see things change a little, but not very much now. But let's get into June. We're going to go to June 10th. Look at how it starts to change here. We start to see the focal point of Vega being right around those strikes, right? So it doesn't kind of smooth out as much. We're only going to get more of a reaction near those strikes, right? Because really there isn't as much Vega, but it's there around the strike. So let's keep going day by day here. So here's another one. Look at how it just becomes kind of these camel humps because right at expiry, basically, there's really no Vega until you're right at the strike, and really it's almost no Vega anyway. So very interesting thing how Vega works. A lot of things get very pronounced in a way at the strike near expiry, like gamma. Vega is much more pronounced with lots of time left, and it becomes almost non-existent unless you're getting right next to expiry on sort of something that has a higher implied volatility. We're going to trail off in Vega a little bit, but we're still going to be quite positive Vega. And so what we can do is we can vol shock it, right? So if I figure this thing could probably have at least 14 points, I think that's being conservative. If this thing collapses, it could go up 20, 25 points. So watch what happens here to my P&L down around 215 if I raise this by 14 vol points. Boom. Look at that. I barely lost any money, right? And then I'm going to actually start making some money to the downside. So this is my Vega bailout, is that implied volatility, I think, could even rise to the upside. Look, if we start going bananas to the upside in Bitcoin and MSTR, this Vega is going to explode as well. That's why I think it's kind of an interesting long gamma, long Vega play when it gets that low. You want to wait till it gets nice and low into the 70s, 80s, and then you have this upside, right? There's no guarantee that it's going to start moving, but it's hard to believe this thing will stand still for too long, especially when you kind of compare this vol to basically when I got in, is basically where it was back before all this started, right? When we were back in here, before the whole new, M2 money supply breaking out, this giant leg up in Bitcoin, and then Trump getting involved in all that pro crypto, et cetera. Right? So we were trading back at those levels. So whenever I see us get back to those levels, that's an interesting play. So basically, I'm gonna play this. I'm gonna see how this plays out. Basically, I'm gonna see how this plays out. We obviously have markets in complete chaos, and this could go either way. But I am long, and I think if markets do manage a turnaround, and Bitcoin does firm up even more, I think this thing could be 350 to 400 fairly easily, which is going to make me a lot of money. So hopefully that gives you an idea of my bailout strategy, how the various Greeks work together, right? It's nice to have Greeks kind of offset each other in a way that sort of gets you out of a little bit of a jam, right? So I'm long delta. Any position that does well to the upside, if I'm long, if I'm bullish, but basically breaks even if I'm completely wrong, or even starts to make money, I'm a pretty big fan of a position like that. That's sort of using options in the best way possible. One of the best ways possible, right? In terms of being long options. So think about that Vega bailout. What you do is you sort of look for options that are trading relatively cheap, and you can position yourself. I like doing these maybe on a trend line breakout. We get a breakout, a pullback to a trend line, something like that. That'll enable me to kind of get long. If it completely fails, then I get the Vega bailout. But if it continues, I use that long delta, I lean into it to play for that upside. So that's understanding how to use the Greeks to your advantage, and we'll see you in the next one.